Hello traders and investors, Will back here with another one, coming to you with a Monday market recap. Hopefully you guys had a beautiful weekend and that you had a very good session in the markets today as well. Now, in spite of the S&P closing green and the Qs closing green on the day as well, it was an extremely volatile session, and of course with good reason, because of the United States' military operations into Iran right now, which obviously saw them assassinate the leader of the Iranian regime, Ayatollah Khamenei, and thereafter did come with some consequences in terms of Iran firing back not only on Israel, on US installations across the Middle East, and targeting 6 different countries at the same time, even the United Arab Emirates and Dubai actually receiving some of that missile fire too. So it was an extremely volatile session. In the overnight hours, you can clearly see right here that from the Friday close, we dropped top to bottom about 1.7, 1.8% on the S&P, over 2% on the QQQs, but then as soon as the markets opened, we got a very big burst of market buying action before closing somewhere in the middle of the range, and the QQQs largely show the same picture as well. So obviously we know that it's a very troubling situation right now with a lot of volatility and a lot of moving parts. But what does it mean for our portfolios and our trades? Should we be selling out of everything and possibly bunkering down? Should we be adding to positions right now? Should we be playing key sectors or some of the volatility perhaps? That is exactly what we're going to talk about in today's video. So speaking about today's video, number one, of course, we're going to do a big recap of some of the major news headlines, not only surrounding the current military operations or quote unquote war, if you want to call it that, in Iran and around the Middle East, but we're also going to be talking about the ever evolving private credit situation, because I haven't seen you guys since last Thursday. And last Friday, we got a very big move down on the XLF. And today as well, you still had a bit of tremors here in relation to further ongoing situations and discussions in private credit. And I will remind you, in terms of our bearish versus bullish narratives right here, both of these situations were previously discussed as volatility catalysts and bearish narratives for the market. Number one being Iran, but private credit concerns and bankruptcies was also on the table. And over the course of the weekend, we've kind of been building a little bit of volatility, obviously, in both of those narratives right now. So in today's video, we'll take a look at the news recap first off. Thereafter, we will do a technical analysis recap of where we stand on the S&P, the Qs, most of our minor sectors as well. Get a sense of the market breadth, get a sense of the market rotation, and where could we possibly be playing these themes. Obviously, many of you won't want to play the wartime themes, as you may deem them to be fleeting, but a lot of you enjoy playing some of these momentum themes as well. So we'll discuss all of that when we cover our index analysis. After we're done that, we will take a look at our big tech names. Big tech actually had a surprisingly good day today. A few of them were down, but a lot of them were up. So recovering from some of the lows that we've seen in the past few weeks. So we'll do a quick little recap of our big tech names. And then at the very end of the video, of course, we will talk about the biggest gainers and losers of the day. Once again, focusing on key themes rather than focusing on just going on over individual charts in, descending order or ascending order, things like that. We'll talk about the themes that are currently in play in the market, how to tie it all together, possibly for some either short-term swing trade opportunities or some longer-term positions that we may want to have in terms of these markets overall. So that'll be it for today's video. I missed you guys, haven't seen you guys in a while. I'm now back in Phnom Penh from the countryside where I had no reception at all. My apologies for no videos Friday all the way through the weekend, but I'm now leaving Phnom Penh, going to Hong Kong, staying in Hong Kong for 2 days, and then I'll be back home on Friday. And as one person commented on my previous video, no, I am not being chased by Interpol. It's just the way that I travel. I love to move around a lot. So thanks very much for your patience and understanding while I've been traveling. I know the video uploads have been later than when I usually do them, of course, and obviously less frequent too. So keep that in mind. We're going to jump into today's video right now. Let's get right into it. So the S&P up 0.06, the Qs up 0.13. And that being said, the rotation today wasn't all that bad. You can notice a lot of a rotation back into some big tech names, but especially software has been getting a lot of love recently. You notice Oracle, Palantir, CrowdStrike, some of the cybersecurity names were up, even names like ServiceNow, Intuit, also benefiting from today's price action. Meta, Tesla, Apple, NVIDIA, the biggest gainer of all our Mag 7 names today, not too bad. The rest of semiconductors, however, However, we're a little bit mixed. You can see the computer hardware segment was a little bit down today, and some of your other large players in semis were indeed down as well. The banks actually mounted a decent recovery from Friday's price action, although nothing big. We haven't reclaimed any levels, and there's a lingering effect of these private credit headlines, which we'll get into in just a few short moments. Healthcare sector continues to just be a little bit balanced and mixed as it operates in around the top end of its resistance range right now, trying to break out from the highs, but not able to get it done today. Eli Lilly contributing to most of those declines. The bottom half of the market, so consumer defensives pulling back, possibly some of the money rotating from defensive back into some of our larger tech trades. However, the highlight of the day, of course, were the war thematic trades, such as industrials, specifically, of course, the defense contractors. Now, although those names were up a lot more in the pre-market hours and the early hours of the session, they tapered back all throughout the rest of the day. So was it a question of possibly buy the rumors and sell the news and just maybe not get trapped into these names? Or are these names possibly good for longer duration trades? We're going to talk about that in today's video as well. And obviously the energy trade moving higher as the Middle East is an area that produces a lot of oil. There have been some threats surrounding closing the Strait of Hormuz. So we'll talk about all that, but the market breadth today was not all that bad. You can see that even better across our one-day relative performance, to where 4 sectors of the market were higher. Good thing technology was up there because they carry a tremendous weight. Energy, industrials once again led by the defense contractors, technology, and real estate. Everything else, sadly, to the downside. On the 1 week relative, we still remain fairly balanced in a bullish leaning bias. Most of your market segments were higher, and the ones that were lower were not down by much. Only defensives, healthcare, cyclicals, and financials struggling a little bit behind the curve. Your fear and greed index after these war headlines remains at a fear condition right now. This is not market sentiment or whatnot. No, it's just statistics in terms of how extended or not extended things are from certain parameters. Market momentum remains at extreme fear because we're just stuck in a range and the long-term moving averages are curling up into the price right now. Stock price strength surprisingly remains extreme greed read right now. Net new 52-week highs versus lows on the New York Stock Exchange remains at the higher end of the category, as we have seen market breadth expansion over the past 2 months. We talked about this so many times, guys, since the start of the year. Maybe large cap and large cap tech haven't been the place to be, but the bottom half of the market definitely has been roaring, and the stock price breadth, as well as measured by the McClellan Volume Summation Index, remains at extreme greed. What doesn't remain at extreme greed is the put to call ratio. Put to call ratio is still very high right now, so many more people buying insurance than they are buying call options, and market volatility also remains at a fear print right now, as the VIX is currently sitting still around the 20 mark. The VIX has kind of been stuck up here, arguably for the past month, as we've moved in and out of various cloud releases, software apocalypses, AI capex concerns for big tech, private credit headlines, and now, of course, the Iran news headlines too. So keep all that in mind. The market just still trying to find a direction. The breadth is still okay, but obviously it's a headline-driven market right now and a sentiment-driven market right now. We know earnings are good. We know that the macro largely is good too. It's just the headline momentum and the sentiment that are driven by that momentum are very strong in the market right now. It's a market a lot about stories, especially when we think about software and whatnot, rather so much than macro degradation at this current time. So that being said, in terms of what we have to look out for the rest of the week, well, not only is it going to be a very busy week in terms of the news that can possibly come out of the Iran situation, well, we also have a number of macro elements to look out for too. So if you take a look here in terms of this current updated week, sorry, I should have prepared that first. We have a few Fed speakers tomorrow, but after that, we start getting more jobs employment figures. ADP employment comes out on the Wednesday session, and that's going to be very curious to look at. And also on the Friday, you get a very big one, guys. You get the non-farm payrolls for the February period, and you also get retail sales and obviously the unemployment rate too. We know that out of all our macro catalysts that we should be paying attention to right now, jobs is arguably the most important one. Inflation is no longer a concern. I know that while I just say that, you guys are probably thinking, well, what about oil? What about if they close the Strait of Hormuz? It's going to lead to more inflation in the short term. Yes, but at the current moment right now, our macro concerns in terms of structural concerns that last longer than the duration of possibly possibly a shorter duration conflict? Well, we have strong GDP, we do have a rate cut situation, you do have still low unemployment, you have lowish inflation, you have very strong Q4 earnings, a lot of which we've covered on the channel. You do still have the AI megatrend and how that's contributing to infrastructure and energy building across the country, and of course the massive fiscal stimulus policies such as the $4 trillion in tax cuts and additional deregulation for corporations too. So out of all of these macro elements, the only one that should be a concern to most people right now is the unemployment rate and the status of the jobs market, which is why these news releases are to be heavily monitored over the course of this week. And obviously the geopolitical situation needs to be heavily monitored as well. In terms of your earnings outlook for this week, you don't have very many big companies, but the biggest one arguably of them all is going to be Broadcom, which reports their earnings on the Wednesday session after the close. Unfortunately, I won't be with you guys because by that time I'll be in a plane Thursday morning with a time delay. So I'll have to cover that one for you on Friday or Saturday when I get back home. But shout out to a couple other companies here, Marvell, Costco, CrowdStrike, right? C Limited. I know a lot of you guys are trying to play C Limited and Coupang. So interesting earnings releases over the course of the week this week. However, the biggest one and the most important ones for markets is going to be Broadcom, just because of its sheer size and its impact across semiconductor sentiment by large and by far. So not a very busy earnings week, but a lot of the hot stuff comes on Wednesday and then on Friday, right? Wednesday, you got Broadcom plus the ADP jobs change. And then on Friday, of course, you get the unemployment rate. And every day you'll have to monitor the ongoing situation with Iran. Now, speaking about the ongoing situation with Iran, we're not going to spend too much time on it. Obviously, my heart goes out to everybody whose friends or family or you personally may be directly affected by this conflict. Conflict is never good, of course. War across the region is never something that anybody should look forward to or whatnot. You understand why the United States is doing what they're doing. You may not agree with it, right? I'm not here to give my opinion, nor to be a political strategist. We're just here to talk about the potential impact on the markets, right? So in terms of the developments, obviously the United States and Israel launching a massive campaign over the course of the weekend, whereby we did see the assassination of not only Ayatollah Khamenei, but also a lot of the Iranian leadership of the IRGC. Now, in response, the IRGC has been targeting several either military installations across the Middle East, whether that's in Oman or Kuwait or even Saudi Arabia, but they've also been targeting some energy infrastructure installations, but also places of tourism such as Dubai. So Saudi Aramco was struck in Saudi Arabia. You also have a large LNG facility that was struck in the area of Qatar. But not only that, there are a few drones that made their way into local airports, such as the airport in Dubai, such as the airport in Kuwait as well. So Iran trying to destabilize the area altogether, whether it's infrastructure, whether it's tourism, and of course several military bases in the region as well, to have a show of force as well, and possibly that the conflict is not going to be able to be resolved in a very brief amount of time as we've been used to recently. You remember the campaign last year in June, whereby the United States flew in bombers over Iran and took out several nuclear facilities. Now, at the current time, no nuclear deal has been made, and that was the whole argument in terms of starting this military engagement in the first place, was the fact that there was just no deal that was able to be negotiated since that time. And as a result, the United States and Israel in a joint task force agreeing that, the Iran should not be allowed to have nuclear weapon capabilities in the region as a whole. So that being said, a lot of different areas were struck, but what does it mean for our portfolios in terms of historical performance? What happens to the S&P 500 when war or conflicts, large-scale conflicts such as these, tend to break out? We have a few different ones here on the screen, and it goes all the way back to Pearl Harbor of 1941. Now, obviously, this is not an exhaustive list. You'll notice that the Korean War is not here. The Vietnam War is also not here, but these are very large events that took place in historical times. Pearl Harbor, the Cuban Missile Crisis of 1962, JFK assassination, the Gulf War of 1990, which was a very big one, by the way, 9/11 attacks in 2001, the Iraq War starting in 2003, February 24 of 2022, which was the Russian-Ukraine situation, start of it at least, and now Hamas and Israel in 2023. Of course, we don't have 2025 last year, but that conflict lasted for all of a weekend, and by the Monday Monday session, the markets actually were able to move higher. So if you take a look in terms of recent memory, right, whether it's 2003, 2022 with Russia, Ukraine, or 2023 with Hamas and Israel, when there was that massive conflict that started in October of 2023, you'll notice that the red bar is the one-day performance, the orange bar is the one-week performance. If we had anything to derive from most of these geopolitical conflicts, it's the fact that most of the volatility and most of the declines can be seen within the first day and the first week of the conflict. Obviously, that's when tensions are the highest, uncertainty is also at its highest, and you don't necessarily understand when and how the conflict is going to be resolved. Now, as time moves on, you get a more clear picture of how the conflict is going to be resolved, who is currently in control of the entire situation, and whether or not there are going to be talks of a ceasefire and whatnot. So usually those things do occur within the first 2 weeks. If you'll notice the yellow columns, these are the 1 month performance of the S&P, and you'll notice that in most all events, except for the Gulf War, which is a very massive operation that lasted several months, 1 month and 3 months, and thereafter 6 months, you will notice that the markets are usually indeed higher. So you may have heard across the media or on Twitter when you're browsing that war is good for the markets in terms of just overall net performance, and this indeed is true, but it may not be true right away. There is a bit of a drawdown period initially in the markets, and there is a bit of a massive volatility spike initially in the conflict, so please keep that in mind. If we take historical statistics, we should indeed be buyers in this market. However, depending on your risk tolerance, you may want to taper the pace of those buys, or perhaps not buy at all until there is a more clear path to conflict resolution, and that is completely understandable. I'm just here to present you these statistics. If we move on here, one of the largest things that happened over the course of the weekend was not only the military campaign to begin with, but the largest impact on the markets had to do obviously with oil, because Iran struck many different energy infrastructure installations. Saudi Aramco was hit in Saudi Arabia, and also in Qatar, a major LNG plant was hit, and that they export a massive amount of LNG towards Europe, and you can see the impact on European natural gas futures over the course of the day today, up 48% intraday at one moment in time. That was a very big one. Of course, we're going to talk about the Strait of Hormuz, because today you had several IRGC officials from the Islamic Republic of Iran, obviously, saying that they wanted to close the Strait of Hormuz. Now, this, of course, would be shooting them in their metaphorical foot, because, of course, this country exports a ton of oil towards one of their main trading partners, which is China. So if they were to close down the entire Strait of Hormuz, all of these ships would not be able to make their way through. And you can tell how much ship flow there comes through this tiny little region right here, which is called the Strait of Hormuz. Now, obviously, Iran would do that to kind of taper, or rather completely halt oil shipments. And we know that that can hurt many countries. The countries that would be most affected by it are not Europe and the United States. Europe and the United States currently have decent oil reserves on deck right now. But the countries that get most hurt with this are countries like Japan and South Korea, who 70 to 80% of their oil imports come through this strait right here. So although we could deem there to be a large impact in the United States, the United States has upped its production recently, and of course now they also do have access to oil in Venezuela. Now, obviously, this is not a rapid fix, and we're not saying the United States or Europe would be immune to a closure of the Strait of Hormuz, but you can model a certain amount of variability across different risk metrics, and this is what Goldman Sachs did. So you'll see here that the estimated risk premium level for the closure of the Strait of Hormuz and everything that's being done in the Middle East right now is about $7 per barrel, right? If the Strait of Hormuz is maintained in a completely closed status, which has never happened historically at all, well, you would come over here to their risk estimate of about an increase of $18 per barrel. And of course, they're talking about the price of the barrel in relation to where we just started on the Friday session. So you will notice from $67, we perfectly hit those risk barometers. The oil was up to the peak approximately about $7 to $8 today, which was basically the mean case scenario in which the Strait of Hormuz remains open. However, with some big volatility in the region. If they were to completely close it down, well, the risk parameters do elevate to $18 per barrel in terms of an increase over the next month in terms of volatility prior to conflict resolution. Now, obviously, if it lasts longer than that, you will have to remodel, but 1 month seems to be the consensus that a lot of these investment banks are going off of. And of course, a $18 rally would put oil at about $85 a barrel. So you may hear people being very sensational on social media right now, calling for $100 a barrel of oil or $150 per barrel of oil. Of course, that is just speculation, guys. Nobody knows how long the conflict is going to last. Nobody knows when the resolution is going to be given. Nobody even knows if they're going to be able to entirely close the Strait of Hormuz or if it's just not in their own best interest to do so. So many unknown factors. Rather than predict some things that you cannot control, in today's video, we will be focusing on certain themes that you possibly can have some predictable incomes, right? Because these short-term momentum trades, although interesting in terms of having some call contracts on some of the oil companies, or if you guys are playing oil futures, that's all fine, right? But just remember to take your profits as you're kind of working on limited information, and there is something here that you cannot control, which is the date of the resolution. The last thing that you want to happen is be in a very large size oil trade for a thematic play, thinking oil is going to 150, and as soon as the barrel reaches about $85 or something, not because it reaches $85, but at the same time that the trade starts expanding, you have some form of deal negotiations, conflict resolution, or Iran actually says, no, we're still going to maintain military operations, but we will not be closing the Strait of Hormuz formally, right? So many unknown factors here. Do not forget, guys, sometimes you're playing with too many variables that you cannot control. Speculating is fine, but do control your risk. Please keep that in mind. If we move on a little bit further here as well, one area of these thematic trades, obviously the thematic trades for today are oil and everything surrounding oil. You can include shipping containers as well, as it's just the same route. That's a little secondary proxy trade, but a lot of the shipping container stocks are going to be very volatile, but that's also a thematic trade. One that has more staying power is this one right here, military defense spending. Now, of course, what's happening right now is that the United States is going through a tremendous amount of munitions, and Israel is as well, as they seek to bring down a lot of Iranian drones, but also ballistic missiles as well. Now, in terms of military strategy, some could argue that Iran is possibly trying to deplete the United States' munition reserves and Israel's Iron Dome reserves by firing these very low-cost drones. Now, this is an American drone, but the Iranian drones largely look the same, firing these very low-cost $35,000 drones into Israel and into surrounding areas, depleting American and Israel munitions, which are far more expensive. Usually, a lot of these interceptor missiles can range anywhere between, on Israel's side on the low end, $40,000 all the way up to, if you're going to counter a ballistic missile, those interceptor missiles are about $1 million to $2 million a pop. So obviously, right, one tool is a lot more expensive than the other, and the United States manufactures a lot less of those very expensive tools than Iran is able to manufacture these very low-cost kamikaze drones as a result, right? However, what this does show us, and what we've also learned from the conflict between Russia in Ukraine, is that unmanned drones are indeed going to be the prevalent weapons of the future. We also know that military trades have been very popular prior to this conflict beginning, not only because of this conflict, and not only have people front ran, right, this trade because of the impending military conflict. No, this has been a very popular trade since announcing the big beautiful bill at the midpoint of last year, roughly just before the fall, to where military spend actually got $1 trillion more in 2026. And just a few weeks ago, you remember on the channel, we were saying that the administration wants to increase that through 2027 to about $1.5 trillion, which is why this defense ETF has been working so well. LMT, all-time highs. RTX, all-time highs. Northrop Grumman, all-time highs. General Dynamics also moving towards all-time highs. But these secular trends, right, or rather these massive uptrends, started a very long time ago and haven't stopped because military spending has been a very thematic trade over the next, over the past 6 months and over the next arguably 12 to 18 months too. So if we were trying to take not only oil thematic trades where there's a bunch of things that we cannot control, we can actually have a bit more control, a bit more visibility surrounding the military trade, because we know there's going to be a lot of depleted munitions, not only across Israel and United States, but also a lot of the Arabic countries in the region, such as the United Arab Arab Emirates, such as Qatar, such as Kuwait, such as Jordan as well. Keep in mind, a lot of these countries have not had to use their munitions for a long time. So there will obviously be a tremendous need to replenish a lot of these munitions over time. It's going to lead to a manufacturing boom cycle. Not that they're already not doing it, this is true, but even more of a manufacturing boom, not only in some of the legacy players. So a possible way of playing this is just, as we have been saying on the channel since late December, early January, not only can you have exposure to the defense ETF, such as ITA right here, which does have a large portion of their weight into some of the larger players in the market, but also drones, guys. If this situation between Iran, Israel, the Middle East, the United States has shown us anything, is that drone warfare will just become more and more and more prevalent over time, which is why we've spent some time going over some of these drone plays over the last few months, right? Such as AVAV, which was down today off a double downgrade. We'll talk about it at the end of the video. Such as KTOS, such as Ondas, and many more, right? So keep that in mind. Drones, the new technology, it will be used more and more and more in the future, and we're going to talk about that towards the end of the video. But this is arguably a theme that makes more sense and that has more longevity as opposed to the quick and fast-paced headline-driven the oil trade, right? Oil trade can be very fun, but can unwind very quickly and is prone to headline risk. The military trade arguably has more staying power because the military spend is already there and possibly will be increased even further after this conflict is resolved. So please keep all of that in mind as you move through these themes and trying to build some trade ideas in the process. Moving on a little bit further here, we're going to talk about our private credit. So Wall Street hit by UK mortgage lender collapses, raising fears of more credit cockroaches. This was on Friday. So one of the mortgage lenders, MFS, in the UK, unfortunately, collapsing just due to mismanagement overall. And there was some exposure in several other institutions that held some assets from this company, such as Barclays Bank, but also some of the American firms as well, which is why Jefferies was down a tremendous amount on the Friday session, down over 17%. And you also had that negativity pour into other names such as Blackstone, which run a very large private credit division. You got some firms like KKR down as well. And just a lot of the major banks got hit really hard on the Friday session. You'll see here JP Morgan was down 3-4% on the Friday session. Bank of America also did not have the best day at all, down 6%. So the private credit narrative was built back in October when you had the collapses of First Brands and Tricolor, right? Auto lenders, essentially, and and Jamie Dimon was then quoted as famously saying there may be more cockroaches in the system, which is why this headline right here says and calls for more cockroaches. But this private credit situation was obviously exacerbated by the sheer amount of stress placed on credit default swaps for very popular companies like CoreWeave or Oracle because of AI concentration in some firms' balance sheets like Blue Owls and things of that nature. So the private credit landscape right now, in my opinion, it is a very sentiment-driven trade. Are there a few companies here and there that have mismanaged their balance sheets and as a result have too much risk exposure in certain sectors? Indeed, yes, that is the case. But can we paint this sector with a wide stroke of a brush and say the entire financial sector is on the verge of massive collapse because they're not well capitalized and they won't be backed by the Fed? No, I think that's a bit of a far-fetched conclusion. However, it is something to pay very close attention to moving forward, as now we also had today Blackstone's flagship private credit fund hit by record amounts of redemptions. So obviously the sentiment is building and people are trying to redeem their funds from institutions such as Blackstone. Last week as well, we had Blue Owl. I presented it to you guys. They also paused redemptions for their retail-facing fund. This time it's Blackstone. 7.9% of shares were called for redemption under their flagship private credit fund. This is an $80 billion fund. Obviously, a lot of this is sentiment-driven. We know investors very rapidly pulling out some of their capital because of all the headlines that have been circulating recently, and Blackstone actually allowing the redemptions even though it is above their 5% per quarter maximum requirement there. So this is going to be an ongoing situation. As I said, are there a few bad little actors here in the private credit markets? Yes, the tensions are building, but from there to say that the US is on the verge of a massive credit crisis like 2008, I think is a bit of a far-fetched conclusion, at least for now, but we will have to monitor the situation. And as a result, a lot of the financial stocks, although in very good buying opportunity zones, will continue to be a little bit volatile in this process as well. And you can see that the credit market sell-off in terms of hedges right now, the credit ETF hedges in terms of put open interest is at its highest level since 2022. So obviously people buying a lot of protection recently, but as we said, it did not start in the last few weeks. This all started in October, building up because of the First Brands and Tricolor, but also some of the concentration risks towards the data center building from AI. So keep all that in mind. That is a mouthful and was your news recap and some themes and ideas surrounding the Iranian situation. Obviously, I'm not heartless. I know that there's ethical implications to trying to quote unquote profit from some of the themes from war, obviously, right? I'm just here, guys, to present the news and to present my, best takes on how it could possibly impact the markets and how you could be positioned to either withstand some of the blows that the market is currently giving in terms of volatility, or maybe reposition for some key things that may last longer than the conflict, such as the further defense spending and further defense build out. But as I said, guys, my heart goes out to anybody who is affected in the conflict so far. Obviously, war is never a good thing at all for anybody involved. And we all do wish it to stop expeditiously, right? So that being said, guys, that's it for your initial presentation. Now let's dive into some of our charts. Okay, so moving into the good old S&P 500. So we have not broken the range. We are still stuck in the gulag. Support stays put where we are right now, 686 down to about 678. We tried to crack the support level, couldn't get it quite done. Line in the sand still remain at these lows, 678, 677, guys. If you do break that, you will lose all the attempt at structuring this daily uptrend. Of course, the conflict is going to impede the markets in the short term, and volatility should be expected. All I'm here to say is there is a next support area down here, 674 down to 667. And if in the event we have to really unwind the S&P and unwind the QQQ because of the conflict prior to resolution, well, there's a very clear area that we might be heading, guys. And that, of course, is the 200-day EMA. We have not tagged the 200-day EMA since the tariff situation back in 2025. And as a result, if the conflict really ramps up right now, if we're not able to get resolution, you could see an unwind here on the weekly time frame all the way down there, and which would consequently be additionally a touch of the monthly 12 EMA. Now, this would not unwind any long-term market positioning or any long-term market structure, as would be just a very nice casual touch of the monthly 12 EMA. We know that the bullish tailwinds for this market are very strong right now, but we also know that there are a few key bearish narratives at play. Last week, we talked about the Supreme Court tariff decision, of course. We keep talking about the AI paradox between the bubble versus disruption narratives. We talk about the Mag 7 capex, is it sustainable or not? Iran, the new Fed chair, which the markets think is very hawkish right now. The record margin levels, which led to many unwinds and liquidations across many different sectors and assets over the course of the past few weeks. The softer than expected jobs data as of recently, although the unemployment rate is still low, the private credit, and the continuation of the yen carry trade unwind. These are all very shorter term bearish narratives right here, which will have impacts on the markets, which is why it's been proving difficult for the S&P to mount above and clear blue sky breakout territory, because there's just so much at play right now. So many narratives, a very headline driven market that we're in currently. Moving on to the QQQs, same analysis. We once again have not broken the line in the sand level structure of about 597 down here into further support, which is 596 down to about 590. We were making good progress last week, but unfortunately that all unwound and we are once again back to these lows. So you got to pay attention, guys. Break of 596 daily uptrend capacity is now lost by the bulls, and you would just set a lower high into lower low structure, weekly downtrend on the QQQs, and as a result just curl a little bit further into its own monthly 12 EMA. That key level right there is about 585, so pay attention to that one. If we do curl down into it, it's not over until it's over. We're just here to say it's a very volatile market with unclear price action in terms of direction. Some people would argue this is an accumulation phase of the market and just printing a monthly higher low, and I do share that assessment as well. Other people would argue this is the start of a very long phase distribution cycle in which you may see 20 to 30% drawdowns. Now, unless we lose several elements of very bullish macro that we've been having, such as very strong earnings, relatively low unemployment, right, and relatively strong GDP as well, it's very tough to assume that you're going to get a 20-30% correction on the QQQs when we literally just had one in last year. So please keep that in mind. Still, in my opinion, a decent buying opportunity, but not on everything. We do have to be very calculated with our buys, and I wouldn't fault anybody for holding a little bit of buying power back. As a matter of fact, I've been doing something similar as well, right? Phenomenal companies right now that we can't afford to buy for our long-term portfolios, but trading, we've got to be a little bit more cautious and discreet with our buying power in current conditions, because we know a lot of sectors are just not trending well right now. Moving on to XLF financials. Financials, of course, getting tied up in the whole private credit landscape right now. I mean, it's not looking too bad, but the bulls really need to defend 50 at the lows. That's your line in the sand. If you crack that, unfortunately, into tomorrow's session, daily downtrend continues, you would be losing a massive area of structural support, which of course was 52 down to 50. Next stop after that is 48 down to about 46, and that would be a very juicy pullback from the all-time highs on financials. That would be a 14% pullback from the all-time highs. Financials still a lagging sector on the year, down about 6.44% year to date. And overall, though, we will be looking for a 26 EMA touch. Now, this doesn't happen very often. Usually when markets get very turbulent, either in the context of a bear market or a global pandemic or a 2018 tariff sell-off or a 2025 tariff sell-off. So it does not hit these levels very frequently. And there are many attractive opportunities that we highlighted over the past few weeks in financial markets, such as Visa, such as MasterCard down here, such as SPGI, very popular name, very solid name as well, such as Moody's Corporation, significantly off its highs as well. And additionally, some of the banks pulling back into their structural locations too, such as Bank of America pulling back here, very attractive level in the mid to high 40s, and JP Morgan as well, pulling back into here into the 290, 280 level, which could be a very nice structural higher low that the bulls have been trying to set here over the past few months. So no need to go into riskier areas of financials. There are very strong legacy companies that we could be seeking to acquire positions in as some of these financial names come down. Or what I'm doing essentially, guys, is down here, I'm currently building some leap positions on XLF, the ETF overall. Instead of playing these names individually, several of them I do have in my long-term portfolio, but in terms of trades, if you don't want to single out a certain company or a certain specific sector of financials and we want to play the whole thing, well, XLF as a whole ETF after this nice consolidation move and being down year to date, I do believe would be an interesting proposition to carry into 2026 and even some of 2027, which is why my leap contracts are for 2027. Moving on to XLV Healthcare right now. XLV failing the breakout of the highs. They did close a very attractive monthly candle, though, in the month of February, as you can see right here. The bulls trying to go for the continuation trade right now. Although getting rejected in the short term, the long-term timeframes look great. Daily, still in the context of a daily uptrend. They will need to crack these resistance highs again, though. 160 down about 158 is your resistance high. You'll also be looking to continue this beautiful weekly uptrend that they've started right now, riding the heck out of this weekly 12 EMA. And as we said, the monthly time frame gives us all the bias that we need to possibly be long on healthcare. Shout out to Eli Lilly, even though they did drop today. Eli Lilly still presenting a great buying opportunity, in my opinion. From here, range support lows 1,000 down to about the mid 900s. I think it's a very nice area of structure. Even if we lose this level right here, accumulating Eli Lilly, because the chart looks really relatively the same as healthcare, right? Beautiful engulfing move. You'd be looking for a breakout, retest, and run on Eli Lilly. So pay attention if you're wanting to trade something in healthcare. Eli Lilly, obviously one of the strongest names in the sector. So watch for these retest locations for longer duration trades. Phenomenal company and a great setup. Moving on to SMH right now. Semiconductors, unfortunately, ending the day roughly flat. It started off a lot worse, and then NVIDIA was able to actually push higher. So we have lost a little bit of key structure right here, flushing some of these lows around 398, 397. So in the event the expected move is just for a lower high into lower low, where could we possibly be going? Because I'm pretty sure nobody's nervous about the upside continuation, right? That would only happen if, as you can see, the futures are able to constantly turn around some of these dips from the war conflict headlines. If they're not able to do it, though, pay attention to this one down here. 375 is going to be your weekly higher low. Still in the context of a nice weekly uptrend. If you get a little bit softer, though, and start to revisit those, of course, you'll lose a lot of the weekly momentum, and you could just be heading into a bit of very healthy monthly consolidation. 360, 355 would be the area to watch. It would be very close to a backtest of this monthly 12 EMA as this one keeps curling up. And that's the type of backtest that I really enjoy playing on these structural higher lows on the higher time frame. So obviously predicting intraday activity and shorter term trends, in the context of ongoing war headlines is quite difficult. But if we do achieve some of these structural low areas, and we can find, once again, some of our favorite names, as we said, Broadcom reports earnings this week, but Broadcom down here in the lower 300s to high 200s is a phenomenal, attractive opportunity in my opinion. NVIDIA, after their earnings, phenomenal opportunity here. AMD, also phenomenal opportunity down here too. Marvell, just to name a few, right? Obviously, there's the memory names. There's so many other names in semiconductors right now, but these are just a few that I am looking at. So keep that in mind. The semiconductor trade will still be very popular, as we saw from the big tech capex guidance and as we saw from NVIDIA's guidance after their earnings as well. Moving on to the Russell now. The Russell up about 0.92% today. They broke the bullish wedge. Okay, this is a bull flag. They broke it to the downside and closed right back in within the range. It doesn't mean that they're not going to be able to lose this in the future. Usually you would have a bullish leaning bias to the breakout. However, the war headlines have kind of clouded this trade a little bit, right? So we did crack these structure lows right now, not quite losing the horizontal lows at about 258, but pay attention to that. If that does occur, weekly downtrend because of the war headlines, unwinding the small cap trade right now, and you would possibly be looking for a higher low. Where's the higher low possibly going to be set? Pay attention to this area down here, 251, excuse me, down about 248. That would be your retest area for the 12 monthly EMA. That is also curling higher. That would just be looking for a monthly higher low for possible further expansion. So if you're looking for a re-entry trade on small caps and you just wanted to wait for the conflict to blow by, and if your area is achieved to possibly structure the trade, that is the area that I would like to be looking. But as of right now, the bulls closing back within the confines of this bull flag, but it doesn't mean it's going to hold up, right? More war headlines, more volatility, that could lead to a bit more downside, as we did show this chart initially, right? The first few days, the first few weeks could be a little bit challenging for the markets, obviously. So we're contending with more than just, rotation and US macro right now. You're contending with very potent headlines across the planet. So keep that in mind too. XLP consumer defensives down a little bit today. We're not going to spend too much time on this chart. Line in the sand right now remains at about 87.22. The bulls still control the uptrend, but if you get a little bit tired here, we might just be looking for the revisit of the mid 80s. This would be a phenomenal reload area for XLP, but also some of the dividend trades. You can see here that SCHD didn't pull back. That was largely because SCHD has a lot of exposure to XLE. But if you're looking for the XLP consumer staple side of the trade, which has been a big outperformer, pay attention to the mid 80s on any back tests if they do get dragged down with the broader market. XRT, consumer retail, also known as the consumer cyclical names, right? Also trying to set a bit of a monthly higher low down here into the low 80s. Phenomenal buyback area for some of these trades. It's not my favorite trade right now. There are many other key themes and narratives that I'd rather play instead, but I know a lot of you guys are trying to rebuild positions in some of your favorite retail names. Although, some of the apparel brands, they've been a bit mixed. Some of the restaurant brands, they've been a bit mixed as well. If we're trying to take a broad market allocation to the consumer retail trade without picking one individual name, well, the low 80s would probably be the area for a bit of a reload trade right there. Utilities still remains one of my favorite trades for the entire year because we know there's just not enough power for the grid right now for all the data centers being built. So this is a structural theme that will last the next few years, not only weeks, not only quarters, years. And we are looking for any back tests, right? So in the event we come close to the daily higher low, 45.50. Pay attention how they react here to this line, 46.50, which is your daily 12 EMA. Consequently as well, that is also your previous highs set back in October. If you take back too much of the move and the volatility and the war headlines are just too strong even for the utilities market, at the end of the day, guys, pay attention for the higher lows, yeah? My favorite area for a rebid on utilities, 45. We can see it again, great area to build some utilities positions across XLU, whether those are individual names, whether that's the ETF, that's the area, and I may even be considering leaps as well. Phenomenal chart, beautiful weekly uptrend, structural demand that will be lasting for years, still one of my favorite trades in the entire market. Real estate hasn't been performing too poorly overall, even in spite of those credit headlines right now. This is an ETF that measures mostly REITs, but there are several aspects to this trade. If you're looking for a back test, look no further than these highs right here, 42 off of XLRE. We highlighted a few key trades over the past month or two. Vici was obviously a very beautiful trade down here, which we highlighted on the channel many times. So the REITs are looking good, but also some of the home builders, right? In the event that the home builders provide you once again access to these higher low areas, 105, decent area if you're looking for the expansion of the real estate market in the United States over the next few quarters, next few years, as interest rates do come down a little bit further. We know right now it is a big buyer's market in the United States. Not going to last forever, especially when the rates do come down. Not saying it's going to flip the switch on a dime like that, no, but just pay attention to this structural MACD. That's like a year and a half, guys, right, of momentum trying to make a bit of a shift, and they're trying to go for the trend shift as well right now. And moving on further, lastly, to our XLE chart. Of course, XLE booming today, not quite closing at the highs, but a very nice day from XLE as well. This trade was started well before any Iran news actually broke. Obviously, it was helped by the Venezuela situation in early January, and now additionally helped too by the Iran situation. However, this trade was a very easy long. You might remember me talking about it end of December as we were kind of discussing the key themes and sectors to enter into 2026. This was supposed to be only a energy trade, right, for the data center purposes, and just because this sector had lagged the markets for the past 3-4 years, and energy positioning by large institutions was at the lowest that it has been in the past 20 years. So we're seeing a large accumulation zone, and we were just playing the breakout for a few key macro reasons, right? Nobody assumed that we would be getting two big conflicts such as Venezuela and Iran in the span of largely the past 2 months, right? But it has been there. It has helped the trade a lot. This one a little bit extended now at the current time, right? So if we're looking to play this one, it is gone at this moment. If anything, you guys know me, I'm a big fan of waiting for the retest. If they don't offer me any retests, no problem at all. There's tons of other themes and narratives that we can indeed play, or individual names. It's just this XLE trade right now is gone. The perfect moment to enter was back here, and we did call it out many times on the channel throughout the month of December as one of our key themes into 2026. So congratulations if you're in XLE. If you were in it for just energy purposes and that entire thesis, and you got helped by some of the conflicts, well, very good stuff overall. They are currently crossing the MACD for the past 3 months, as you can see, after being down for the past 3-4 years. The weekly overbought conditions, daily overbought conditions too, doesn't mean it can't still run, but similar to gold and silver when they pull moves like this, anything that starts running like this, right, just pay attention, guys. If you're in these, we can set trailing stops at the new daily higher lows. That way, if they crack these and unwind the trade, you do not have to sit through big weekly consolidation in your position, right? You can keep playing the structural lower highs as they set them, keep increasing your trailing stop, and that way when they go for the bigger pullback, you can take yourself out of that trade with some very handsome profits without any guesswork, right? You're just waiting for a reversal of the higher high, higher low structure from a daily uptrend into a daily downtrend. That will let you know that the move is near to completion and that you're probably looking for a bit of a cool down. Last but not least, moving into the VIX. Of course, the VIX, when they opened this morning, 25. But the VIX has been stubbornly sticky around here for the past month for several different reasons. Of course, the SaaS narrative, right? The AI narratives, the incessant cloud releases, the Mag 7 CapEx spending, all that good stuff led to the initial flurry of VIX spikes over the course of the past month. And now recently we got a big spike in volatility because of the geopolitical conflicts too. Now, that being said, usually, as we did bring up, right, the volatility and the returns to the downside in the markets are the highest usually in the first week of the conflict. So no, I'm not calling for the VIX to be suppressed back down to 15 immediately, but you could just be seeing some of the highest volatility days that you would see amidst the entire conflict. Still a very good opportunity to sell covered calls against very profitable positions that you are seeking to wind down as trades, not on long-term portfolio stuff. I never sell covered calls on my long-term portfolio holdings. It's just not worth it for me. However, for trades that we're looking to wind down, covered calls, very attractive with the VIX premiums, and also selling puts under the market on names that we would like to acquire or just playing the wheel strategy, still very advantageous right now because with the higher volatility, with the higher premiums, they give you higher premiums down the options chain. You do not need to play things too closely. Matter of fact, I'll just give you a concrete example, right? AMD at some of the lows this morning, right? With the increases in volatility and the VIX, you were able to find 170 strikes for the next 2 weeks. When the VIX is low, you can't find that deep on the options chain and still get 0.5% per week in doing so, right? So selling put options in this environment on high quality companies that you would not mind being assigned at prices that you would not mind being assigned at. That's how I enjoy playing the volatility in the markets currently overall. Just farming some premium, right? So that's everything for your overall index rundown. Hopefully you enjoyed that with a little bit of a thematic twist. Now let's dive into gold and silver. All right, so moving on to gold, obviously one of the conflict hedges of the moment. So as we can see, gold right now broke out to some highs of 0.82% to the upside yesterday, and even today, or rather, in Tuesday's overnight session right now, it's still an inside candle, but up about 0.71%. Now, gold has been a very easy trade recently, as we've referenced many times on the channel, just a very clear daily uptrend structure. So until the bulls lose that, which would be a break of 5,100 roughly, the bulls are still looking good for continuation, possibly towards the all-time highs. Now, it's not going to be done in an absolute straight line. They can set several higher lows in the process of doing so, but suffice to say, the bulls are indeed back in control of the short-term timeframes. The weekly trend is currently back into expansion mode after setting the higher lows after this big liquidation breakdown here. And now we are structurally looking good to move towards the all-time highs. The closure of February's candle, very bullish candle structure for some continuation. Now, of course, we are trading this with a stop loss, but our next take profit, if you were in this trade with us, whether you bought these lows or whether you bought this back test that we were talking about as well, you would set some higher lows right now in terms of some trailing stops below 5,100, and your first take profit is 56 all-time highs, and then the break towards 6,000 psychological, so keep that in mind. Silver trailing a little bit behind, right? Not as powerful of a move in relation to the all-time highs as gold has been, but still the structure remains roughly the same. It is currently still a very nice uptrend by the bulls, although we are trying to set some higher lows. 85 is the line in the sand to pay attention to here, guys, right? You don't want to give back too much of that. If you do come down here, 83.6 would be a key area of congestion. You can see that was a big area a few times in the past. So silver is basically a carry trade for gold right now. Gold is leading, and whatever move gold does, silver is kind of carrying. Obviously, silver being the more volatile asset, but all trades made on silver should be taken using gold as a guide right now, as gold is truly the leading asset in terms of recovery in relation to its all-time highs. As you can see, silver is still substantially off of its own all-time high. So if I were in a silver trade right now, I would be using gold as my guide, whereas before, silver was kind of leading the charge for a large period of time here, December through January, in terms of percentage gains and just the explosiveness in the silver trade, which we have not seen a lot of over the past few weeks. As a matter of fact, gold has regained its structure a lot better than silver has in recent times. Speaking about Bitcoin as well, it was a curious move across the cryptocurrency landscape over the course of the weekend. Now, you can clearly see that when the news broke on the Saturday session, we had a big decline on Bitcoin, and then bulls bought it up. And even yesterday, or rather today, Monday, 4.66% on Bitcoin to the upside, and even Ethereum showing a little bit of risk on movement right now. Obviously, nothing has changed in terms of the time frames right now. The bulls are still struggling to establish some form of a daily uptrend right now. We did still have, though, today the first close above the daily 12 EMA, and that's notable to us because they haven't really done that since the early portion of January. So once again, we do have a tradable low in on Bitcoin right now, but we cannot call it an absolute low. It's a tradable low because they finally reset the daily uptrend structure right now, and we can have a tradable stop loss location. And you would be going for the expansion, or rather re-expansion, of the Bitcoin trade. Now, obviously, the war headlines are going to play a big portion of a big part in this. I'm not saying that Bitcoin is just going to be able to absorb all the war headlines and just make a straight move up, but at least you have a tradable bottom, and you would be targeting, right, just a bit of a weekly lower high. Thereafter, the bulls need to change the entire weekly trend back too. But this structure looks quite appealing for a short-term swing trade, which could bring you into the low 80s region, mid 80s region, back to this resistance high, if that is going to be the true directional move of the market, right? So there is a swing trade opportunity with nice risk to reward. Doesn't mean it's going to play out. It just means that there is a change of structure in which we can capitalize on if we're looking to make a bit of a risk reward bet on Bitcoin. And even the same can be said about Ethereum, although Ethereum, kind of like gold and silver, right? Bitcoin has the better chart, but shout out to Ethereum as well. Tradable lows are in on Ethereum at this current time as well. 1840 would be the stop loss area. And once again, you would be targeting top end of this resistance range, which is 2,500, and then the extra top end, which would be 28 for some expansion right there. The weekly looks like it's curling over here on the RSI. It looks like it's curling over the price, but trade with a stop loss, because the last thing you want is to be unwound, and that's not your weekly low. And this is just, again, a bear flag similar to what it was last time. And you get unwound and they go for the lower structure support, which is roughly 1,500, 1,400 all the way down there. So crypto is still not my favorite trade, but I still have to present you guys those trade opportunities if they are on the charts, right? So that's everything for our overall market rundown. Hopefully you guys enjoyed. Now let's dive into big tech. We'll spend about 10 minutes here, and then we're going to spend 10 minutes on the biggest gainers and losers, key themes. So Apple up about 0.2%, but they did have a very bad day on Friday, 3.21. Friday was just not a very good day across the markets overall. Daily uptrend structure is still maintained, but you can see the bulls are struggling here. We're kind of trapped between two areas, unable to break the resistance highs, 276. Now they still do have a daily uptrend, but the bears have taken back a lot of this move. Resistance stays put 267 up to 275, and below support 255 down about 246. Now you might remember me framing Apple as kind of a Mag 7 hedge trade because they just do not have the sheer amount of capex. They have very good product releases in the iPhone 17 and new products which will be unveiled this week, as a matter of fact, so pay attention to those. And additionally, well, a lot of people have been running CloudBot on Mac Mini, so they got demand for the iPhones, they got demand for the Mac Minis as well. The trade not looking too bad. I would be indeed a short-term buyer of Apple if we do find our way back down here into the 250, 245 lows, which once again I will remind you would just be looking for swing lows on the monthly time frame here, looking for some re-expansion. I wouldn't go into it with a tremendous amount of size, but it could be something interesting to watch in terms of the upcoming few weeks with the market volatility. Moving on to AMD. AMD at one point today was down over 3, almost 4% before recovering most of that. Still closing in the red though, and AMD, similar to Apple, caught between two levels. Overhead resistance, which we are unable to break, which is 215 up to 230, and below support 190, then about 178. We're coming into the 200-day moving average as well. Clear rejection by the bulls today. Doesn't mean the bears can't take another stab at this and try to dive deeper into the support range and possibly fill some of this gap. This was the OpenAI gap, of course, down here in the mid 170s. Now, you know me, I'm a big fan of AMD. The thesis is still very much intact in terms of the huge growth they'll be having over the next few quarters. Most of that growth does come second half of 2026. I do believe that any AMD positions currently being built, especially in this lower range, will be rewarded, especially coming into the next few years. You got the CapEx guidance from big tech, you got the deal with Meta, you got the guidance from NVIDIA as well, all things pointing to the fact that there will be a lot more GPUs and even CPUs needed in the future, and AMD is there to kind of support that incessant demand for compute, right? Look at this EPS ramp and the revenue ramp. So the AMD thesis is definitely not broken in spite of the fact that there's been a lack of momentum recently. Valuation under $210 is very attractive for billing out those positions. Moving on to Amazon right now. Amazon trying its best, right, to keep up the daily uptrend attempt that they tried to make over the course of last week. We will see if they can do it. You need a break of 212. Break and close above 212. Daily uptrend is indeed back. If not, you'll be in a similar situation to Apple and AMD, which is that they're stuck between two levels right now. We are stuck in the confines of resistance, which is this box, 205 up to about 216. And if you reject and come lower, you're coming right back down here, guys. 197 down to about 189. You guys know my stance on Amazon, although Amazon got sent down after earnings because of the $200 billion in CapEx spend. Still one of my favorite trades in the entire market right now. Amazon, a company that will be making $1 trillion in revenue by 2028 and trading at relatively fair multiples down here at about a 1.35 peg. All lines of the business are operating in a very nice fashion right now. So I am a dip buyer on Amazon. I know it's been slow. I know there's been a lack of momentum, a lack of overall expansion from the all-time highs, but I do believe this year and next year are going to be some years in the sun for Amazon in terms of the overall business. Now that we have multiples compressing a little bit, very decent opportunity in the markets in my opinion, and or I am playing some short puts down here under the 200 mark. If I get a sign down there, perfectly fine with that. I mean, the weekly 200 EMA is curling up quite rapidly into this region, so phenomenal location to be buying Amazon in my opinion. Moving on to Google right now. Google obviously suffering as well. They just haven't been the same ever since they reported those earnings, right? The bears have been in control of this chart and additionally now too. So pay attention. Line in the sand break would be down here, 298. Okay, if you break that to the downside, daily downtrend continues, you can notice that you are below your moving average. There's a change in structure. We haven't done that since, all the way back here in May. So obviously the momentum has shifted gears to favor the bears right now, and you're underway into weekly consolidation. If they do break, that's your weekly lower high and lower low, right? Some people would argue, well, this is a head and shoulders pattern, and I would agree. That being said, if you do break down here, we're going for what I've been calling for here for the past like 2 months. Not predicting it, but just saying, I'll be patient, and when Google offers me a monthly higher low, that's when I'll be willing to play. So that higher low could come into play 280s down to about 270s, which will put Google about 20% plus off of their recent all-time highs. It would be a nice reload area for me if we're looking for any swing trade longs, and would be the completion of a classic monthly higher low into the 12 EMA, which Google has done many, many, many times over its historical chart, right? So keep that in mind. Not interested in Google up here, but bring me down to the 280, 270 location. You might find me trading a bit more. Moving on to Meta right now. Meta as well, not doing too much. Meta too, trapped between two locations. A very small support box right here, 645 down to about 630, and overhead resistance, 680 up to 705. That being said, the bulls still struggling to get an uptrend breakout right now. Line in the sand break to the downside is 630. You lose that, you're coming into the big boy area of support, which would be roughly 605 down to about 560. Now, either of these regions are phenomenal opportunities to be buying Meta. The chart in the short term is very ugly, lack of price action control, lack of a clearly defined trend right now. One thing is very clear though, which is Meta's valuation. So although short-term swing trades are a bit tough to, well, they're not very tough. There is one right now, right? The lows pretty much would be your stop loss, targeting the highs of the resistance range for a breakout. So risk to reward is there for a short-term trade, but the clearest opportunity in my opinion is just long-term shares of Meta. Meta trades at a very low forward multiple right now at about a 22 under 660 and a 1.17 peg. Very attractive valuation. Moving on to Microsoft. Microsoft up 1.48%. Now, that being said, it's trying, right? Still no clear break of structure, similar to Netflix, okay? And we'll cover that chart next, right? Microsoft is trying to do something that they haven't done in the past. Since this earnings release in October, it's been nothing but daily downtrends, never recapturing the uptrend, right? These equal highs, no daily uptrend, and then the daily downtrend resumes, nice pre-earnings pop, more daily downtrend, and now you got an engulfing move. They're trying to set the higher lows and go for the daily uptrend break. Whether or not they get it, that obviously is the speculation aspect of it. I am a person that usually waits for confirmation. I would love to see something like this, exactly like Netflix. You remember when Netflix broke these structure highs, and we said that's the first daily uptrend that this company has had in months and months and months, and also breaking above the short-term 12 EMA, it led to some very nice continuation. Now, of course, there was the deal and everything like that, but still, the structure was broken and it provided us with a tradable bottom. So if we're looking for a tradable bottom on Microsoft, the same logic needs to be applied. We wait for the daily uptrend break of structure, wait for the recapture of the 12 EMA. Of course, we were monitoring a few things. This is bullish divergence, excuse me. We had the most oversold conditions that we've had on Microsoft on the weekly time frame since 2006, and you were also at your weekly 200 moving average. So there's a lot of confluence down here, plus it's a massive support zone as well, right? A lot of confluence down here, but until they give us the trend change confirmation, you cannot say it's the absolute bottom on Microsoft. It's a nice area to go looking for structure changes, and that's what we are monitoring, right? So pay attention to that right now, because as of right now, the bears are still in full-time control. For longer-term investors not concerned with any swing trades, still a phenomenal opportunity. Picking up Microsoft close to the 200 weekly EMA at a relatively low valuation below 410, 1.34 peg, very attractive for the legacy company. Speaking about Netflix, the chart we just covered, Netflix, clear trend change structure break, as we were just saying, right? Beautiful daily uptrend, continuation, and now getting a bit soft as we move into the $100 psychological level, which is our previous big area of congestion. Let's be honest, yeah? Big previous area of congestion, 200 weekly EMA, or 200 daily EMA is right above here at about $100. So the bulls may encounter a little bit of resistance. The good thing though, they have a ton of room now to set any higher lows. So pay attention to Netflix. If you do set some higher lows down here, I'll be taking advantage of this possibly by selling some put options down here now that we have some structure changes. At $97, is Netflix still a good deal right now? Well, it's trading right back to around a 34 price to earnings at about a 1.55, 1.6 peg. So the valuation is not as cheap, obviously, as it was in 76. That's for sure. I was saying Netflix was a very good buy down here for long-term portfolios. It's still a decent buy up here at 97, but you might be, you might be rewarded by waiting for a little bit of the retracement to the downside and trying to restructure these trends one by one. Give me the daily uptrend back, which we have. Excuse me, a nice weekly move, and then possibly looking to reset the weekly uptrend in 2 motions as well. Moving on to NVIDIA right now. NVIDIA up 3% on the day. Very strong push by NVIDIA. However, caught in the magnet range, 185 down about 178. So short-term bears are definitely in control, as we did lose the higher lows here at 179. Post earnings sell-off, in my opinion, I don't think NVIDIA should be trading down here, but it is. What can we do other than say that? Is it a good opportunity down here at 182? And you guys know my thoughts on the matter, right? Accumulation zone for the past 6 months roughly, while improving guidance, improving transparency on the business for the next few years. Excuse me. That's something in my throat. And lastly, around 195 as we measured it after earnings, right? I mean, it's, no more than 7-8% lower after that event right there. So that being said, price to earnings on a forward basis is still very low 20s, and it's right around a 1 peg. NVIDIA is still a phenomenal pickup in my opinion. It's just not going to move like it had before, right? It's a $4.7 trillion company, so you shouldn't be expecting a 2x in 6 months on NVIDIA. Frame your trades and frame your entries accordingly, right? Mid 250s expansion over the next 12 months makes a lot of sense. It makes perfect sense, but thinking NVIDIA is going to go to $400 in the next 6 months, that's unrealistic. But the chart looks clean, the valuation is very good, so I am participating. Moving on to Tesla right now. Tesla also breaking down below its 200-day moving average right now. Still in the confines of support though, 405, down about 384. So the bull is just not in control right now, right? Still a daily downtrend. So once again, similar to all the other charts here, you need the daily uptrend recapture to prove that these are indeed your weekly lows, and those are possibly indeed, upon weekly trend reversal, the monthly higher lows too. The chart structure looks very attractive right now in terms of just the bulls trying to reset here into the lower bound of support, but this is going to be a rising tides lift all ships. You're not expecting Tesla to have massive rallies if the SPY and QQQ cannot break out, and if you don't have the rest of the Mag 7. That's very obvious, right? So Tesla should be viewed in terms of that landscape overall. There is a tradable location right now, and it's the break of support. If you're looking for this one, trade it with a stop loss, right? If you're trading without confirmation of your time frames, you always got to have a stop loss if you're trading, right? But if you're trading without the confirmation of your time frames, right? 382, break of 382 on the lows right there, it'd be a clear loss of support, and you'd be going one level lower at 355. So do not get unwound if you're building swing trade longs from this position, right? Trade it with a stop loss, because if you go one level lower, it's going to take them a lot longer to reset from there. Moving on to Palantir right now. Palantir being part of the Defense Corporation push today. Obviously, right? 6% almost to the upside. Very good day. And Palantir did something today that they haven't done in a very long time. Can you guys see it? It's kind of like Netflix, right? For a very long time, Palantir, right, was unable to set the daily uptrends. They make an attempt right here, get rejected. Downtrend, 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 lower lows, equal lows. And we were keeping an eye on this one, right? Equal lows. Could they set the higher highs? Higher highs are set. So trend change structure right now, daily uptrend, break of the 12 EMA to the downside. So the trend is definitely not looking as bad as it once was. Clear trend change break of structure. Tradable lows are in right now at about 126. And if we're going for the daily uptrend expansion trade, it can take a few legs, obviously. You're looking for the weekly expansion leg as well, which could take you into the mid 160s all the way up to about 170 at the high. So pay attention to that if you're looking to swing trade Palantir. Still, the company's valuation is front and center in everybody's minds right now, but this indeed is a structural low that the bulls are trying to set up right now. Obviously, the play is perfectly thematic to the ongoing conflict right now. Moving on to SOFI. SOFI up about 3.55%, but it was down on the day again to start off the morning. Nice pushed up by the bulls, though, and it came perfectly down into our area that we've been talking about, right? 17 down about 14 bucks. And we were saying, yes, SOFI under 20 at 19 was a good buy. The only problem with that, if you're trading, you had no areas to trade off of, right? There's nothing here. That's the yellow line, and I put it there for a reason, just to show you guys there's nothing there. If anything, with heavy momentum to the downside like that, you are favored for a restructuring down here into the actual support area. Now, that being said, it is currently low at about 33 on the weekly RSI. It did come down here into daily oversold conditions, presenting a bit of bullish divergence as well on the RSI versus the price, and this was going to be the reaction zone. The bulls reacting to it nicely, but it's not a trend change until it's a trend change, just like Palantir, just like the other ones, right? Give me a trend change, then you can say, all right, tradable low is in, and as a result, you can have a bit more upside overall. If you're buying from here, then your stop loss should still be today's low, because you do not want to get unwound more than that. It's fine to speculate a little bit in terms of catching falling knives and tradable bottoms like this, right? In terms of, you got the bullish divergence, you cracked out of support, the bulls put an engulfing move today. There are some things to speculate on towards some upside. Not as good as the setups that I like to clear with a clear daily uptrend to show you that they mean business and they just won't unwind for a lower low, but still there is something here. And in terms of the long-term investors, obviously at about 18 and about 17, the valuation is quite compelling, being around a 1 peg and being around a 5 forward price sales. A couple more and then we're done right here. Moving on to Uber. So Uber up about 0.7%. So not too bad. Daily uptrend structure change on Uber. We covered this last Thursday as well. Tradable bottom is in. $70 would be the lows at which you're looking to establish a possible tentative stop loss. And if you're looking for the weekly uptrend reversal, right, the swing trade, longer form swing trade, you would be targeting a recapture of these highs around the mid 80s levels. That would be the price target. So the lows right down here, 70. So you're looking at about $5 of risk for about $10 of upside. It's roughly a 2-to-1, but it's not a one-day trade. It is a structural trend reversal trade that the bulls are attempting as they move into this area of support. And obviously this is just looking for a monthly higher low on the monthly time frame. So doesn't look too bad, and the valuation around 75 is quite compelling for the long-term investors out there. Uber, phenomenal company, but sentiment-driven sell-off recently because of the autonomous vehicle push by Tesla and others, although Uber has large network effects, which we all discussed when we discussed their February earnings on the channel. And last but not least, Taiwan Semiconductor, TSM down 1.46% today. One of your market leaders in semiconductors, no questions there whatsoever. However, even the good leaders tend to have some breathers sometimes. These higher lows right now, 357, it is your line in the sand. If you lose this structure, yes, you can devolve into a consequential daily downtrend, and you would just be looking for a weekly higher low. This area right here should interest a lot of people, 341, going for the swing trade weekly higher lows. Look for price action to stabilize around that level, and thereafter we can place a tentative stop loss, right? If we're looking for the higher low entry here, stop loss goes there, right, with the entry around 348, and then we're looking for expansion beyond 400. So there's going to be some good risk reward on TSM. TSM, right, obviously one of the best performing companies in the markets over the course of 2026 in the semiconductor niche so far. Very solid name, very great profit margins right now. I'm not adding any to my long-term holdings at all because the valuation, even though quite compelling, just I personally have enough. But if you would be looking to add, it'd probably be back down here, 350, 345. Great visibility from this company over the next few years in terms of revenue streams, profitability, and especially pricing power. So that sums up all of our all of our indexes and all of our big tech names. Hopefully you guys enjoyed that. Futures, as you can see, are still very volatile, as we are probably getting continuous headlines right now over the course of the evening from the ever-evolving Iran situation. Now, let's move into some of the biggest gainers and losers with an emphasis once again on our themes. All right, so talking about theme number one, we're going to talk once again about the drone. So AVAV was initially up today by a very large percentage, guys. You're talking about a massive swing here. It was up as much as 19% early hours of the morning before getting a double downgrade here from Raymond James. Now, that being said, from the top to the bottom, that was a 33% swing back into support down here, 229, then about 204. Now, I am in this name personally in my long-term portfolio. What happened today essentially is that the SCAR program, basically a space program, which had a $1 billion to $1.4 billion backlog for AVAV. What happened is the government reopened the bidding cycle for other various companies to kind of step in. AVAV did not lose the contract. It's just prior to this bidding being reopening, they had somewhat exclusivity surrounding that contract, but this is exclusive to space. Now, if you know anything about AVAV, is they do much more than only space, especially a lot of military applications, right? So I'm buying this one, not for the space contract, but I am buying this one for the drone capacity, right? So this one could be very interesting as they kind of get out of this volatility. The company right now is trading at about $10 billion, with pretty good visibility into their backlogs in terms of revenue, right? You'll see that all the analyst price targets are still above, despite that double downgrade by Raymond James. EPS, very nice expansion too. And revenue, if you look at their exit rates for 2027, 2028, it's about $2 to $3 billion, right? So keep that in mind. A lot of military contracts will be on the table. $10 billion valuation. It is quite manageable and quite approachable, especially at $200. Although the price action looks a little bit ugly right now, as we may come down and tag the 200 weekly EMA. So I am a buyer of AVAV under $200 or close. Keep that in mind.
just something for you to research. In terms of other drone names that I'm heavily exploring, KTOS has a very nice setup right now too. Looking down into these lows, KTOS popped a little bit off of the war headlines today. You guys know the drill, right? Down here, mid 80s is where I'm interested in really building some positions in this stock overall. Same thing as AVAV. Their valuation is about $15 billion, so it's in that whole mid cap range. It's not very large cap like Lockheed Martin and those things. Not that there's anything wrong with playing those names. Beautiful EPS expansion, and also beautiful revenue expansion as well. The exit rate for 2027 and 2028, about $2.42 billion. So you're trading at like 7 times, 8 times forward sales for 2027 right now. The valuation is not excessively cheap, at least not as much as it was back here at 40 bucks, right? But still not egregiously expensive. So I am a buyer of KTOS in terms of just accumulating some shares in the 80s and even below if it drops there into our 12 monthly EMA. That being said, also some of the small cap names such as Ondas. Ondas should be very popular moving forward. Another drone exposed name. My favorite location on Ondas personally is anywhere between $9 to about $6. Still uncertain if we're going to get that, but selling some put options could be a great way to farm that location down there. And another one, edge compute for the battlefield right now, which was technology that was implemented in Venezuela, and I assume will be used currently in the Middle East as well, right? Which is basically edge compute in the form of very small little AI servers, which help for targeting systems, right? That are placed on device, right? Whether for strike teams or whether for drone purposes or anything like that. Very interesting play. OSS, I am building a position right now. Anything in the 8 handle all the way down to 6. I'm a big fan of rebuilding. This was a very popular trade early January. We talked about it many times. Now that it's consolidated a little bit, I am building a bit of a position. And shout out to the upstream AMPX. I am also building a position in AMPX. They're basically batteries for all of the drones. So keep that in mind. AMPX, very interesting. From current levels, I am building, but also all the way down into the 9-8 support region. Very interesting name for you guys to pay attention to. And LPTH as well is another military-oriented play that I'm taking. This is germanium. China has a 70% stranglehold on the germanium market. This is American-made products with American sourced materials, and it does help in in terms of imagery and guidance systems, right? In terms of the lenses and whatnot that go into it, in terms of manufacturing processes for various weapons. So keep that in mind. LPTH, I am a buyer as well. I started a position earlier in the $10 range last week at some of the lows, and I am a buyer down here, 10 all the way down through 8. These are longer term positions, guys. I'm not looking to take these trades and be out of them in the next few weeks with this conflict. No, not at all. Anything I build in KTOS, Ondas, AVAV, AMPX, LPTH, I will be holding for the multi-year expansion trade of this thesis, right? And it goes once again in line with American production facilities, right? Trying to capture some of the vertically integrated American producers of these that do not necessarily rely on China, which is why OSS comes into play, which is why LPTH comes into play, which is why AMPX comes into play. And then it goes into some of the larger drone manufacturers, such as AVAV, such as KTOS. But then again, there's nothing wrong with playing the aerospace and defense ETF. If you want to play that route and play the legacy makers, nothing wrong with playing this right now. Although it is a little bit extended here on the ETF basis, it is still a very clean weekly uptrend, providing very clean tradable lows if you are swing trading this. But also just having a position in these for the next couple of years is probably going to be a very likely theme to be recurring on an ongoing basis. Shout out as well, I do have Kraken, which is a play that I talked about many times last year when I built the position in the roughly just under $4 range, or right around $4. It's since expanded very nicely. This is propulsion systems for companies like Anduril, which is a private company, defense contractor, of course, but also in partnership with the U.S. Navy for several contracts too. Still a relatively small company, $2 billion company, right? So this whole robotics, drones, right, different military contractors for the new wave technologies that are in the market right now, very interesting. And shout out to this one as well, which I'm exploring. Laser. Obviously, if you guys have seen some battlefield footage, you can see that Israel has recently implemented their laser systems for taking down either rockets or missiles fired into their airspace. It's brand new. They implemented it last November or December, if I'm not mistaken. And we have seen some first clips of those systems in action over the skies of Israel in recent times over the course of this weekend. So very interesting here. Laser, they make a couple of components. Obviously, this market is currently dominated by larger players such as Raytheon and Lockheed Martin, but very interesting that this company has several components in those Israeli defense systems. Company's trading for about 3.71 billion. I get it. The chart is completely blasted right now, right? But if you're buying this one, we're buying it on a pure market cap expansion thesis. Obviously, we would love to see some pullbacks, and I'll be a big fan of watching out for those pullbacks. No position for me right now, just something to keep on the watch list, right, for modern warfare technologies in the future, right? Think just drones, laser technology right now, and obviously critical minerals that go in to a lot of these manufacturing processes, such as USAR, which I'm in as well right now, at the lows down here of just under $20. We're commenting on this beautiful chart setup structure right now. The U.S. government obviously has a direct investment into USAR, so pay attention to the critical minerals trades. UMAY for antimony, which is also something used in defense contracting too in terms of raw materials. Charts looking very nice right now. So, you know, critical minerals, and then how that ties into the entire energy trade. Very solid right now. We can also talk about the energy themes as well. I'm kind of jumping here. I'm not, as I said, I'm not going to go through, you know, ascending or descending order on this chart. Just talk about the key themes that we're seeing play out right now. Bloom Energy is a trade that I highlighted several times on the channel into the last 2 weeks. Very nice consolidation range at the top end right here. Daily, the bulls are looking for the uptrend expansion. I have a small swing trade position on their way on BE right now, looking very good. Breakout, retest, and looking for the re-expansion trade of Bloom Energy towards the all-time highs. Bloom Energy, right? The energy trade can be broken down into many different parts. This is just one of them, right? This is fuel cell conversion technology. It plays in perfectly in tandem with something like a GEV, with the gas turbines converting natural gas into energy via the intermediary of these very large gas turbines. So BE and GE Vernova are a very nice pair trade right now, in my humble opinion. But you also have many other large-scale utility plays, which I'm a big fan of right now. Vistra being one of them. Next Era Energy being another one of them too. Next Era Energy, we highlighted this one a lot on the channel in the past few months. Gorgeous cup and handle, breakout towards the all-time highs. This is 4 years, 5 years almost of consolidation. And the good old inverse head and shoulders on a monthly time frame. And the 3-month quarterly time frame, guys, you're looking for a quarterly MACD cross. I rarely ever bring up this chart, but when I do, it's because usually you're seeing a big structural shift. So NEE, I do have some leap call positions on NEE, continuing for the furtherance of the breakout. But once again, this is not a 1 week trade, a 1 quarter trade. No, we're going for the next 12 to 18 months. The themes that are going to be here for the next 12 to 18 months. Energy, defense, right? We know are going to be very big ones for different purposes. Defense because of the amount of spending, right? And number 2, energy will also because of the amount of spending, but also the eventual bottleneck that a lot of these names are going to be facing in the future, right? So please keep that in mind overall. Now, those are the 2 key themes that I kind of want to touch upon for the end of the video. Obviously, there's many more. We can talk about the second order of the AI plays, right? The bottlenecks in terms of the AI suppliers, right, which a lot of people have been focusing on recently. Names such as AXTI, super solid right now in terms of a 22% move from the highs. If you're buying this one, you're buying it for the squeeze on up the supply chain, essentially, right, on the INP substrates. So that being said, 2.56 billion. Has it ran an absolute ton? Yes. Are you late to the trade? Well, yes, in relation to the people that bought down here, but arguably the bottleneck is real. XTI can still move up a lot higher, right? Analysts may indeed be light on their estimates, and there's not that many analysts that cover this stock to begin with, right? The ramp beyond 2027, analysts have given no visibility to whatsoever. So keep that in mind. If there truly is the amount of bottlenecks that people say there are, which indeed there are in terms of, you know, various forms of silicon or various substrates or whatnot, this is the area. Additionally, you're going to see there's been a notable fall off here in the copper trade, right? Credo reporting great earnings today. Stock went down 7% in the after hours. ALAB hasn't been the same as well, right? So you're seeing a lot of these very popular connectivity trades with cables and anything copper associated to the data centers being sold down in favor of what exactly? We've been talking about this for the past month, in favor of photonics, which is a division of the market that prior to a few months ago, nobody was talking about, let's be frank with you. And now it's pretty much everything people are talking about right now. Light is obviously our market leader. AAOI has been making the rounds recently, up a phenomenal amount after their earnings, 56% just in one single day after their earnings coming into last Friday's session, and up an additional 21% today. This company, if their backlog stays true for their exit rates through 2027, guiding for about 4.5 billion by the end of 2027, then this company would still be structurally cheap right now. There can be some further upside, but keep in mind, it's a very hot narrative. It's a very volatile trade overall, so it's not going to be for everybody. It also requires a little bit of research and a little bit of expertise, right? Because this is connectors, okay? Now, Broadcom is working on a technology that would completely circumvent the need for external connectors overall. All right, so pay attention to this. That is the counter thesis for names like AAOI, right? So you got to know what you're trading. You got to know the SWOT analysis, the strengths, the weaknesses, the opportunities, and the threats. There are big opportunities right now for the photonics division, but there are also threats from legacy players like Broadcom who are trying to circumvent the entire need for plug-in connectors overall and just replacing them with on-board fiber optics purposes and connectors and things like that, right? So pay attention to that, guys. It's a very complicated trade. I'm not going to spend half an hour talking about this trade overall, but just something for you guys to pay attention to. That's been very popular. Coherent has been very popular. Fabrinet has been very popular. GLW Corning for glass has been very popular since their Meta deal as well. This is where the money has been flowing recently. If you're confused as to why popular names of the past like Credo Technologies have been down, ALAB have been down, the copper connector plays have been down, right? Look no further than Wall Street money and the big institutional money rotating quickly and very rapidly into the photonics plays. Just something for you guys to pay attention to. Obviously, we're talking about the key themes and the big market movers of the day today, so we're not going to talk about why Dollar Tree was down 5% or why Lululemon was down 4.86%. I haven't talked about software in a few days, but you guys know my thoughts on that. IGV, in my opinion, they're trying to form a bottom off of big weekly oversold conditions. The best, or actually my favorite area, not the best because that's open to interpretation, right? But the area of software that I do believe will have great longevity and great visibility amongst all of these software sell-offs is cybersecurity. So this would be one that I'd be willing to position in. I'm not so much positioning in any of the legacy software names now, such as ServiceNow, such as Adobe, such as CRM, a lot of the legacy names such as Monday.com, such as Atlassian, that have sold off tremendously from the all-time highs. No, I'm not doing those. The only aspect of software that I would be bidding, in terms of a recovery fashion, would either be IGV as a whole, because the top two holdings are Microsoft and Palantir, right? So I'd either be playing the entire software niche, or if I wanted to pick apart one little niche within the entire software trade, other than Microsoft and Palantir, which we cover on a daily basis, right? It would be cybersecurity, and there's many different ETFs. It's up to you guys to do the holdings analysis, right? CIBR is a very decent one. They hold a large position in Broadcom in this ETF overall. But just pay attention to cybersecurity because a lot of the bigger names such as Palo Alto Networks have sold off substantially. Palo Alto Networks into its 200 weekly EMA, and even CrowdStrike as well, right, has sold off quite substantially from the highs. So cybersecurity is one that I would be looking into more heavily, right, if I wanted to perhaps take a position. So those are all the themes that we talked about, right? Energy and all its components, the utilities therein, right? We also talked about defense, drones, the cool new laser technology, right? All things of that nature. Upstream from that, the critical minerals that will be used to either power, anything from magnets to military defense purposes and whatnot. Talked about USAR, talked about other things of that nature, right? Talked about UAMY. We didn't talk about these, but obviously some of the uranium plays, right? Still very popular. LEU. If you just want to play URA, you guys know me. Structural deficits here in uranium. Very popular trade. Very, very good for the next 12 to 24 months, in my opinion. Copper as well. Copper bottleneck is very real. Copper now outperforming, right? Very nice structural recapture of the uptrend. Pay attention. This is the copper producer chart. Not for everybody, but for you guys paying attention to this stuff, right? There's so many nice themes to play right now, many of which have heavy spending over the next few years or big bottlenecks, right? Uranium, big bottleneck. Copper, big bottleneck in the future. The grid overall, big bottleneck. Several components of military applications, big government spending. Critical minerals, big government spending, and bottlenecks. So there's so many key themes. If you are trading and if you enjoy momentum, right, and following the money where the money's hot, there is something for you. If you're just an average long-term portfolio investor and you just don't want to chase themes, you just want to stay true to just what I talk about on the channel all the time, right? There's great opportunities all over the place. Many of the Mag 7 names are in extremely attractive locations. Visa, MasterCard, SPGI, Booking.com, all attractive locations. Companies like Uber, companies like Airbnb, companies like Shopify, right? We can't go through them all, but there's just so many great companies, many of which will not be affected by AI in a negative fashion, that are trading down and that are at very attractive levels. We talked about AppLovin, right, recently too, arguably one of my favorite SaaS plays right now. We talked about Axon, obviously, too. They were up today as well. We talked about them before earnings and after earnings, saying there was a very nice buy down here because of their ecosystem. So there's many interesting names in the market right now. Whether you are a long-term portfolio investor looking to build positions in high quality compounding companies over time that have great business models and great moats and great competitive advantages. But on the flip side of things, there's also a whole bunch of themes and narratives that we can play in these markets because of either heavy government spending or because of eventual future bottlenecks that are caused by the AI trade. So essentially what I'm saying is there's something for everybody right now. Absolutely something for everybody, and I truly do believe that in the markets currently. But that's all I had for you once again, guys. So that's it for me. Hope you enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new to the channel as well. Would love to have you back. And last but not least, if you have any questions, comments, feedback, or if you guys are looking at any plays, definitely leave them down below in the comments section. I always love reading your guys' comments. And that's it for me. I will see you tomorrow. Tomorrow will be the last video of the week because thereafter I will be traveling back home. And then so expect a video Tuesday market recap, no Wednesday, no Thursday. I'm flying back home. It's like a 24-hour ordeal. And then I'll probably be making a weekly recap video on Saturday back from good old home. So that's it for me, guys. Take care. Hopefully you had a good day in the markets. Peace.